So volatility really looks at fluctuation day to day, even hour to hour fluctuations that happen in the marketplace, all the moves up and down. And depending on what your goals are, you may look at this differently. You may look at these fluctuations on a daily basis, an hourly basis, a monthly basis. But what it comes down to is what is how volatile the products you're trading are. And this little diagram here is a nice indication of the differences, right? So more volatility, we're going to see these, up and down dramatic moves in the marketplace. And the less volatile products, we're going to see less movement in the marketplace. Now, depending on what your outcome or your outlook is for trading, you may decide that you want to trade more volatile assets for some of you. And for others, it may be that you want to trade options that have that less volatility in them. And that's really kind of a preference on what you determine you want these outcomes to be. So volatility is defined the rate and degree of fluctuations for whatever security or the marketplace is going on. High volatility is that rapid change in the markets, and the low volatility is the more stable and predictable alternative. So we're looking at historical volatility. Now, historical volatility is a look back. So historical volatility typically is, depending on how you're looking at it, could be end of day sales or opening of your particular options, but it looks back on what has happened in the past. And it's not necessarily a predictor of the future, but it certainly is a way to determine like where you might want to purchase a stock purchase, right? Or what happens when earnings comes out? How dramatic is that movement? And I know people that measure that change after earnings come out, and they'll look at whether or not how dramatic that change is up or down. So sometimes you might, if negative news comes out, the stock goes down, usually pretty rapidly compared to when good news comes out. And they'll use that information, that percent of the, change for the next earnings that are coming out. They might put on a different kind of position based off the information that they gather from what happens after earnings. And all that information is found in these historical volatility charts. So distribution, what makes this interesting is when you're looking at historical volatility and comparing it with distribution and standard deviation changes, that distribution for a lot of traders is how they look at risk. So if you're looking at, the standard distribution and you're looking at your risk, right? So if I am trading, stock A here and I have historical volatility of 15, basically that means it's going to probably trade in a smaller range than if I was looking at stock C, where historical volatility is 35%, then I'm looking at it trading in a larger range. Now, when I'm looking at risk and I'm looking at standard deviations, right, that it comes with this, when I'm looking at standard deviation risk, then I'm using that to indicate what is going to happen to my position if the stock moves 1, 2, or 3 standard deviations.